Hello, 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 and welcome to another podcast on the Can I Own podcast, helping you to reach your dream of home ownership. I am your host, Art Veal, and today I'm very excited because we're jumping into a topic that I love to discuss. The question came in today: does it make sense to pay off debt when I'm planning on purchasing a home? So the question is basically, do you want, or is it a good move to start paying off debt before you're purchasing a home, or when you're about to look at purchasing a home? And this is something that I've helped a lot of the tenant buyers and people that I deal with. I've helped them resolve because that is a good question. You don't know if you should leave your credit alone. Some people tell you to leave your credit alone and don't touch it. Other places say that you should pay down everything that you can. So I'm going to give you the 5 rules that I go by when I'm talking with a family to help them make this decision. I'm going to tell you those 5 rules, and then it should help you in your planning and process to figure out what you should do. So the first thing about paying off debt before buying a home is that it will not necessarily help you. A lot of people get the misconception that when they have, let's say, a poor credit history, or they have things on their credit, maybe judgments or collections, that the best way to improve your credit is to pay those judgments or collections off. When actuality, that's not the case. And I'll give you a reason. I'll explain why. Credit bureaus use scoring models to figure out your credit score, and the scoring models don't always think like a regular person thinks, so they do things a little bit differently. For example, if you've had a collection on your credit, let's say it's 3 or 4 years old, something, it's an old phone bill or old cable bill, something that you paid didn't pay off when you moved maybe from one place to another, and they've got it as a collection or something on your credit. That collection is years old. So your credit score, when the algorithm looks at your history, it actually kind of discounts that past due collection because it's years and years old. It gives more weight, or it gives more interest to new things that are on your credit. So if you don't pay a credit card, or miss a credit card payment this month, that's going to affect your score much more than having a $300 collection on your credit as far as scoring goes. Now, there's a difference between scoring and what lenders look for. Sometimes lenders are looking at things that they require you not to have. So they might say, we require that you not have any collections, or we require that you not have any judgments. But for credit scoring, the credit score does not put as much weight on a collection that's a few years old versus a missed credit card payment, because it looks like to the credit scoring, it looks like you are having trouble now, and that's what it's concerned with. Now, on the other side of this, so that's my first tip. Paying off a collection or a judgment or something like that on your credit will not always increase your score, so it's not always the best move. Now, the other point that I make to people is that not all debt is created equal, or at least in the eyes of the scoring models when it comes to scoring your credit. Paying off, let's say you have a credit card that has $1,000 balance on it. You have a limit of $1,000. You have $1,000 balance. What I teach people in the 6-week course that we offer, the 5-week course that we offer on getting prepared to buy a home and getting qualified, is that there are 2 ways to use this credit card that you have to increase your score. And one of those ways is to pay down the credit card debt. Typically, lenders like to see your credit card, they like to see that you're not using all of your credit. This especially is true with the scoring models. The scoring models penalize you if you're using all your credit. So if you've got let's say through all of your credit cards and your car loans and your whatever payments you have on your credit, you're extended a total of $10,000 in credit, and you're using $10,000 or $9,700 of credit, the scoring models will actually penalize you because you're using so much of your available credit. So if you learn the right percentages that you need to reduce your debt by, you can reduce the debt to that percentage, and then your credit score goes up dramatically because you are within their threshold or their guidelines of what someone that is in good credit standing should be. They don't like to see you have all of your uh, debt out. You owe all of your debt. So that's the second point. The third point that I like to make is sometimes there's a better use of your money. When you're sitting down making your plan on how you're going to get qualified for a home loan, you have to look at what's the best use of your money. Sometimes the best use of that money is to put it toward a down payment. Sometimes the best use of that money is to put it toward income reserve. So having money just in the bank to show that um, you can afford life after you get this loan on a house. So you have to weigh, does it make more sense to put the money toward the down payment, put the money toward reserves, or put the money toward paying off debt? And you have to look at what your lender wants to see, or the particular loan program that you're going through. You have to know what they, or at least you have to have a general guideline of what they want to see. So I go over that a lot and discuss that kind of thing, but you have to know those guidelines, and then that will kind of dictate to you what's the best use of that money. Should you be using that money to pay off debt or doing other things with it? So the next point that I like to point out to people is your debt is not always equal. So it depends on if you're making payments. And what I mean by that is, let's say you've got a collection account that is $300, and you've got a credit card that is $3,000, and you're making payments every month on that credit card. Even though they're the minimum payment, you're making a $30 payment every month, and you'll pay it off in Timbuktu, but you're making payments every month, and you have that collection. Which one of those should you pay off? Well, the answer is quite simply that the debt that you're making payments on is not as detrimental to your credit as the debt that is in collections. But there's a caveat to that. It's not as detrimental if the collection is recent. If the collection is older, then you would want to put the money toward paying down how much you owe on that credit card. If the collection is newer, meaning you got it in the last 6 months, then you would probably want to go ahead and set up not a payoff of that debt. I either suggest that you do a payment arrangement where you make payments on that collection account, start making payments again, or you do a settlement. And there's a specific way that you need to do a settlement with that creditor so that it benefits your credit. If you do it that way, then let's look at what you've done. If you make the payments if you pay down your credit card debt, then you increase your score because you lowered it over the top threshold on your credit card. Or if you use that money to pay off the collection in a settlement, then you've satisfied that collection, but you've done it in a way, the way I teach people to settle collection accounts, it will help their credit because there's a specific way you need to settle collections before you pay them. Or if you make payments on that collection and you have a payment arrangement set up, then when you're going to your lender, you can show that payment arrangement, and that collection won't count as a bad debt, but it'll count as an account you're making payments on. So you have to be very specific in your plan, but at the same time, when you're setting this plan up, once you know what to look for and how to look for the pieces that can help you define what will increase your score and what won't increase your score, then you'll know what's best to pay. It becomes very clear. Now, the last thing that I want to point out, or the last point that I like to make about paying off debt when looking at a house, is it's better to have the right debt for a lender. Lenders actually like you to have certain debts. And I don't mean like you. They are more, I guess, open, and it looks more stable to them when you have certain debts. So there are three kinds of debt. There's consumer revolving credit debt, so credit cards, things like that, unsecured credit cards, a Visa credit card, a Discover card would be an unsecured revolving credit card. Then there's retail credit cards. So if you have a specific store like a Target or a specific store credit card, that would be a retail credit card. Then there is fixed secured debt. So secured debt is something like a car note because that debt is secured against the car. Then there's also under secured debt. There's things like bank loans and things of that nature. Um, Lenders like to see that you have a mix of credit. So they like to see that you have some bank secured loans. They like to see, or at least one bank secured loan. They like to see that you have some maybe retail or kind of a specific credit, and then they like to see you with some unsecured credit. Now, if you don't have this mix of credit, then you can quickly build that. You can quickly build that those types of credit, even the secured credit is with a bank, but it shouldn't be a secured credit card. I'm not a big advocate for secured credit cards because secured credit cards often charge a lot of fees. And unless you get the right secured credit card, they don't even report to all the credit bureaus, so it's not really benefiting you. But if you have the right secured loans, then you can still get the same benefit at a much lower price or rate, interest rate, and you can get make sure that it reports to all the credit bureaus. So you want to have a good mix of all of these particular types of loans. When they see that, not only do they see it and it helps them, but the algorithms that run from credit scoring will also see that you have a mix of debt, and that increases your score. So in short, the answer to this full question of should you pay off debt when buying a house is that it depends. It depends on where you are in your credit life right now. You need to take a good long look at what you're doing in your credit life and what kind of debts you've had in the past and what you're doing with those debts. Some people just need to make a few tweaks and then they're ready to go with a lender. Some people need to make major changes, but if you make those major changes at the same time, you can be ready to get financing. I've dealt with families that were so far from getting financing that I literally had a lender tell me, I don't know what to tell you about this person. They've got 26 pages on their credit report, and I don't think they'll ever be able to buy a home. That family, we were able to help that family buy a home in about 6 months. So it really depends on having the right plan, understanding what's good and what's bad on your credit. Even a person with horrible, horrible credit often has some things that are good on their credit. They just don't see them as good because maybe they were past due or maybe they've got a bad payment history. But there are ways to work around that and ways to get you in a position where you become attractive to a lender. So you just need to know that. If you want to know more about this subject, then take a look at the products that we offer on CanIOwn. We offer a bulletproof budget DVD, which is great for helping you establish a baseline budget and how to make sure that you can systematically reduce debt and build savings. So take a look at our bulletproof budget DVD. Or we also have a credit building webinar, credit repair webinar, excuse me, that we put together. And it goes over the exact details and the exact process that we use to clean up someone's credit and get them in a position where they become more attractive to a lender. And finally, if you need help with more than just credit, so if you're, for example, you want to get qualified for a home loan in the shortest amount of time possible and you're not sure where to start, we deal with a lot of families that have talked to lenders and the lenders giving them the runaround. Once lenders typically know that you're not ready to buy right now, they give you some general, go do this, go do that, but they don't really help you hold your hand and guide you through the steps that it takes to quickly get qualified. Our 5-week course on getting qualified for a home, our 5-week home buying course, is an excellent way where we touch on credit and how to get your credit in order. We touch on income. If you have not only your income for self-employed people that typically have more trouble showing their income, but also if you have contractor income, so people that Uber or people that do side jobs or side gigs, we show you how to put that money together so that lenders will count it and it can benefit you when it's time to get a loan. Take a look at those if you're interested. I hope this has been helpful to you. We do have we've put these podcasts on to iTunes and Google Play, and we've gotten a lot of interest. I've gotten some great feedback, some questions from different users that are listening. I appreciate that. I think that's great for the podcast. If you have questions, be sure to go to CanIOwn, the blog, and ask your questions. I'll be happy to answer them and touch on anything that any questions you have. But go to iTunes, do me a favor, go to iTunes and leave us a review. Let us know what you think. Let us know what we should change. Let us know if we're doing a great job or we're really messing up. I'd love to hear your comments and your thoughts. And until next time, I look forward to talking with you. Hope this information has been helpful, and I'll see you next time. This has been Artville with the Can I Own podcast. Until next time, thank you. Bye-bye.